Hello guys, welcome back. My name is Joseph Samuel, and in this lesson we are not just talking about premium and discount, okay, as basic 50% of division of price, okay. I also will just look at premium and discount with preferences. That is, we are diving into the institutional levels use of premium and discount, and how banks, hedge funds, and smart money uses reference points, okay, with liquidity, fair value gaps, and other blocks in these zones to enter high precisions and low risk trades. Okay, so if you have been confused about where to find snapper entries, this lesson will open your eyes to the architecture of price. Okay, but before we dive into the course deeply, I want you to click on the subscribe button and comment. Also, like our videos and keep the vibes high out there. Share it to your friends so we can actually grow to reach more people. All right, so earlier on we've discussed about premium and discount, but let's go back to the basics, but in a deeper way. We defined a range as a significant price move from swing highs to swing lows. So what we mean is, when price, you know, I've explained earlier, but let me just re-explain it. When price is moving, taking bullish movements for instance now, a price is moving, this price leg, the movement of this price leg from where it starts from to where it's end its trend is called the impulsive leg, right? And when it comes here, we have it as a retracement. Now we say that the difference between this swing low, this here is what we call swing low, and here is swing high. So the difference between this movement, this impulsive leg, the beginning of this impulsive leg, to this um, ending of the impulsive movement, right, is what we call a range. So at that range, we want to use our Fibonacci tool, right, to know what is divided into the premium and the discount. That we want to know the 50% of it, and we mark from the swing low to the swing high, and we see that we said that price, we wait for price to come into this 50%, below the 50%, before you can journey again to continue in the upside. We said again that the difference between here and this here is called the premium. That is, market is at the upside. I don't want to buy at that point. Okay, and we also said that below the 50% is what we call our discount, where we'll be looking for entrance to buy. Okay, entrance to buy. But the truth of the matter is that the institutions don't buy randomly. That's why they know that price is actually in a discount. They look out for um, price to deliver into specific reference points. Okay, specific reference point within those zones. Now we already know that below this 50% here is discount. So if we mark out our zone, we already know that price will definitely come back to below 50%. But where exactly at that below 50% is what the smart trader, they want to actually watch out for. Okay, so in that alignment, we will just arrange the institutional reference points from highest to lowest based on the priorities. I'll just be listing them. So just get your pen together, just get your pen and paper and follow up. So I won't just be typing so that I don't have so much of long videos. So I'll just mention them, then you write, and I will explain, then you move on. All right. So the first thing the market makers want to look out for is what we call liquidity pool. What I mean liquidity pool? Liquidity is actually the blood of the market. Let me call it the blood of the market. That is the money in the market. They don't want to be caught anyhow. Before market makers takes directions of trade, that in market structure, we explain that market can move like this. Let me say for a market can move. Okay, let me say bullish. Market can move like this, right? come and take this one and still go up like this, right? And come back again, take this one again and still go up like this continuously, right? Price can do like this. That's because they don't want to beat the liquidity. Some people will buy at this point, and when they buy at this point, hoping that price will not come back. Market come and take that their stop losses and go on. So the first thing the market makers are looking for in the market is liquidity. Liquidity are they are found in various places among the market. Okay, they are found on equal highs or equal lows. Okay, so maybe price do like this one. Let's say price do something like this. Okay, people who trade double bottom, they say that this is a double bottom and they want to buy, right? Probably they buy up there, but later on the market will definitely come back and just wipe them out and come very low. Okay, and most another thing is that any market structure or any retracement that is not below 50% when you mark your range. Like if I mark a range of this movement, right, from this price leg to this high, okay, sorry, to this high, this was the initial high, okay, we will see that this price leg retrace method did not reach out to just average of 50%, okay, sometimes maybe on 48 or 30 something like this around this point here. When you see price like this, just know that once the retracement is not up to 50%, price market will come back and take it out because that will be the liquidity the market is coming to grab. Okay, so market makers will first look out for, is there liquidity pool in the market, right? That's the number one preference they want to take out. So when you have liquidity pool above premium, you know that it's a sell opportunity for you. Okay, and okay, and another thing that liquidity pool can also be found along trend lines. Those who trade trend lines, um, um, trend lines mark, whereby you say, okay, let me just show you on the chart so that you don't just be watching schematics. Let's see them on the chart. So for people who trade trend lines, for instance, now this is a daily time frame. Okay, many will say that okay, let me just go to lower time frame so that we can see them plenty. It will be easier to see um, on lower time frame more. All right, so trend lines um, above or below recent highs and lows. Okay, those are where liquidities are found in most cases. USD has been bearish for a long period of time now. We're in a bearish moment. Okay, so let me see. I have know what a trend line is, right? Let me just draw a trend line. For let's say market is this in the downtrend now. I can just mark. Let me just mark randomly. They are nothing. Okay, so those who trade trend line, for instance, can trade this. They can trade this trend line like this, hoping that price is reacting somewhere like this. Okay, so people can say, okay, stop to trade the number of touches one. If I pick like this too, I think this can also give me another one. Let me just mark this one like this. So this is another trend line. So people trade trend lines at times. Just say, okay, touches one, two, three, they buy the third one. In most cases, you see our market, the market just take it out here, right? Uh, those who trade breakouts too, we feel like it has broken out. And what happened again? Market take them out again, continue the upside, and come down again, and see, you know. So liquidity, these trend lines are where liquidity lies. Okay, that's where liquidity lies in most cases. Some liquidities, all right. So decisional, when they see liquidity above premium, they know that that's a sell opportunity. That means like we are still maybe trend line, all this little gap, little breakout like this. Then you see liquidity below discount. They know it's a sell up, buy opportunity for them. Okay. So the second thing we'll be looking at is the fair value gap. All right. I'll just be listing. Then subsequently we'll do breakdown of each one. We'll teach them in details. But for now, just get the basic ideas and use it to structure your trade entries. Okay. So fair value gaps. Fair value gaps is imbalance in the market. Imbalance says that where price market we just form three candle pattern formation too, whereby the wick of there's a gap between the wick of the bodies of the close of the three candles. Let me just say I have three candle pattern formation. Market is trading downward like this. It's trading this way. Now, normally for every price delivery, okay, the wick of this candle supposed to touch each other. Okay, the price is not supposed to have any gap between them. But now that you are seeing gap between them like this, sorry, now that you are seeing the gap between the either the wick of the candle or the close of the candle. This one I don't have a wick on this candle, but we'll see them on chart. And you are seeing gap between them like this. We tell you that price will definitely do something like this. As it's coming down, price will definitely come back to this point and fill in that imbalance and then continue downward. So that is what fair value gap does. But let's just see little of it on the chart here. Let's little of it on the chart here. So you can see this one here. See this movement here. You can see here and here there's imbalance of the candle, right? You can see here and here there's still imbalance in the candle. See how price came in for this one. Our price has filled up this imbalance, right? See how price came into it, right? Came into it and react, okay, and react. They'll still come back and invalidate it. And when it invalidated it, we call it inverted fair value gap. Price will still use that inverted fair value gap to trade in opposite direction, or whichever way. We'll treat inverted fair value gap later on. We'll know what those ones mean. All right. So, but this one here, this another gap. You can see this another gap. There's a gap between this candle and this candle. So you can train your eyes to see them very well. Some of them are not as big as this. Some of them are tiny. They are very, very tiny. So if you are not careful, you may not even see them. You may not see them very, very well. Okay? You may not see them very, very well. So you have to train your eyes to see those. I'm trying to look for tiny ones so that you can just cite an example. For instance, this is a gap between this candle and this candle here. There's a gap. Market came back, they're filling, and see how price rejected, right? So you train your eyes to see many of those. This is liquidity void. Of course, when you have liquidity void, there are several imbalances. There are multiple imbalances, like many fair value gap. So knowing which fair value gap is actually valid, we'll treat them when they are dealing with a fair value gap. But now we're just listing the references of what to be looking out for. All right. So you look for fair value gap within premium for sales. Okay. So if market is in a downtrend, for instance, now this 0 USD is currently, if we check daily time frame, okay, we'll do real life analysis later. Let's just continue. This. So you look for these opportunities of what is it called? Fair value gap on premium, you are selling, and if you see it on discount, you are buying. Okay, if you see it within discount zone, what you are doing is you are buying. You are taking advantage of it. Okay, you are taking advantage of it. So best entrance when price return to fill the imbalance, especially after a change of character, because when price doing change of character, or break of structure. Okay, market price always leave fair value gap behind. Like what I mean is this: if price is creating a new directional change in character, let me say let's have let me see if I will see a very price definitely leave a fair value gap behind for you. It will leave fair value what I do. It will leave fair value gap behind for you once they are doing their change of character or break of structure. It will leave fair value gap behind for you that they are coming to fill. Okay, they are coming there to fill. Look at this market now. Market has sweep liquidity. This is an inducement now. Market sweep liquidity, like we explained that the first thing price want to do in a discount price is they want to sweep liquidity. When big market see that they swept liquidity and they did this is a minor change of character here. They've done with your character at this point. And if you are using this place, this is also a main sweep of liquidity. Price did they change your character. Let me zoom it so that you can be seen very well. Okay, so you are seeing as price did what change your character. After doing this change of character, they will leave fair value gap behind that they are coming to fill. So after it has done this low, created a failure swing again. Okay, after sweeping this liquidity, it created a failure swing, which is if you know that this will need to tell you that buy model is setting in. If you have not understood or if not watched the video on how to know when to buy the market, go and watch the video. It's on the YouTube channel there. How to know when to buy the market, buy model for market structure. So failure swing. After a failure swing, you see this change of character, right? Uh, if you take it here, because let me just use here. Okay. Now you see that price actually created what a fair value gap. And where is fair value gap? See this candle and this weak candle. You can see there's an imbalance there. Three candles, right? Let me zoom it very well for you so you can see it very well. So you can see the imbalance here. One, two, three. What did price do? Price came back into it. Price came back into the zone. Just tap it. Just tap it and go. And this another change of character again. Oh, sorry, break of structure again. And you can see one, two, three. Fair value gap. Price came into it. If you mark it out again, you see it. You see it here. Price came back into it and tapping and tapping like that. So when price keep doing all of those things, they will always leave fair value gap behind for the smart money traders to come and fill in for them to go on. After this major break again, if you allow this major break, if you allow this major break of structure, if you allow this major break of structure, you see that price also leave what imbalance there. And you can see how market came into the imbalance, right? You can see how market came into the imbalance and and tap in, right? And tap in. And if you check each of the tapping, you are seeing your three candle pattern formation. One, two, three, swing low. Tell you that market is, and this is inducement. This is liquidity. When you see this consolidation, these are liquidity that market will also take out. It's also liquidity pool. We've accumulated orders here, and that will take them to the once they see that they treat the market like that. The another thing we'll talk about is number three is the order block. So all this order block. Order block is actually the last. Okay, let me explain. I have bullish order block and bearish order block. Okay, so the last down candle before a bullish move is what called um, bullish order block. When I say the last down candle, when I mean down candle, I mean a bearish candle. So if price is actually coming down, if price is actually selling, okay, coming down. The last red candle before price begin to go up is called, it's an order block. Like, let's get, and green candle the last green candle, okay, or the last up candle before a bearish move is called a bearish order block. So for now, as market begin to come down like this, right, before the continuous rally of continuous green movement here, this last red candle that price printed is the order block, okay, is the order block, okay. And if price, as price is going up like this last green candle before the bearish movement is the what's it called? It's a bearish order block. Okay, so you want to see some of those things. That's another reference point markets use. So we'll treat them very well on how to use them to pick trades. Okay, how to use them to pick trade. Market do this and come down, bam, like that. You look at them on how to use them to pick trade, because in most cases, let me just explain something schematic, right? When price is doing um something like this, right, the last red candle before this impulsive buy movement, price can, people used to mark it out as a zone. Let me just hold this there. People will mark it out as a zone like this. It will just be like the last red candle like this. Okay, let me change the color. Let me change it to red. The last red candle like this. Okay, we'll just mark it out, box it out like this, and expect that price will come out. If not fully inside, price will come and tap into it to continue to the upside. Okay, price come and tap, so we'll mark it out and we're waiting for that price will, if price is here, we're waiting for the price will come back here. That's how people mark out zones, right? They want a price to come back here and tap in, and once it tap in, they are expecting that price will continue to the upside. So you can just hold on to any of them and work with. All right, then I'll move on. The next one we want to see is a breaker block. So what is a breaker block? Breaker block is just, or rejection block. Breaker block and rejection block, they're just failed order blocks, okay, that turned resistance into support. Okay, they turn resistance to support like that. So when you say breaker block, mean that price normally, sorry, price is expected that when, let me do another schematic. When you have price going this way, right? Now we expect that this order block right here should be respected. Mean that price could do something like this and trade up. That means this also here, there'll be another order block here, right? And that red candle, it should also trade up, right? Now when price is coming down, we expect that the one coming down too, to respect it, it should push price up again. But instead, price did what? Price failed, break it down. Now when price breaks it down, this becomes your breaker block. And what will we be expecting? People will mark it out and expect that price will come back to this card, because you have marked it out as order block before, right? But price actually break it down. We expect that price come back to this point and tap into this block, and we expect and take trade in opposite direction. That are people trade M and W pattern, M pattern and W pattern. This is what they sometimes do. You just mark it out like this. You just mark it out like this. This red candle, right? Just mark it out like this, and wait that this price, after it has broken it out, it should come back there and then pick and tap into it. Then they pick trade in the opposite direction. Of course, what they want to be seeing, also want to be seeing their confirmation entrance before they pick. While some will just use limit orders. Whether the for here now you use sell limit and place it here, stop loss above somewhere here, and you target lower. Okay, so that those are what those does. Then we have what is called mitigation blocks too. Mitigation block. The word mitigation block. Mitigation block is where price return to close out unmitigated position. It's also very similar to um other block. In mitigation block, it's just more or less like failure swing on its own form. When you see that price normally, right, in a bullish scenario, same thing is happening to bear scenario. Or let me say price like this. Now I saw that price will actually break this leg, right? Now this guy refused to break this guy. Instead, it does more like failure swing and now come down like this, right? This now becomes our mitigation block because at this point now it does not feel it didn't break here and it allowed price to also break through it. So we expect that price will also come down here and also do something like this and trade down. So we box out this point. We box out this point and wait that price will come down there and trade down. The same thing also for buy model too. You also for buy model, this is the same model. For buy model too, you also want price to do something like this. Fail to break, right? Then what happened? We box out. Sorry, fail to break to the fail to break, right? And then we'll box it out, wait for market to come into the zone here. Then we'll pick trade and go in opposite direction, either way, like that. So same pattern, same stuffs like that, like that, like that. All right. So I think let me put it and let me just do a summary. So of the distribution reference. So I mentioned strip of liquidity. I mentioned delivery into fair value gaps. I mentioned mitigation blocks or other blocks. Okay, so mitigation block or reaction from another block, right? Then confirmation, basic confirmation with change of character or break of market structure. Okay, then you expect price to deliver back into your discount or premium price before you finally tap your entry. All right. So let's just do one practical chart flow. All right. So let me say that price is in a bullish scenario. Which market is currently bullish? Currently, all these markets are currently bearish. But let's just explain. Our price pushes from a swing low to a swing high, right? That means low to high range. That's your range. You know what that means, right? Then price come back below equilibrium. Now we are in discount zone already, right? We are in discount zone. Now, what do you think you will do? What do you think you will do? The first thing you will do is to look out for sell side liquidity. Okay? When I mean sell side liquidity, that means below equal lows. Like, is there any equal lows? Is there any trend line liquidity, double bottom double top thereabout? You want to see sell side liquidity, double bottom and the likes. Okay? Then you want to see that is there any fair value gap into the system? Is there fair value gap? Then near the other block, you know what another block is, right? So is there any fair value gap close to another block? So if this is your mitigation block, for instance, now is there any fair value gap close to this region? If there is, and it's on premium, okay, for a year now, it's on premium. I want to sell. Okay, okay, I'm talking about bullish scenario, right? Then to be on a discount, you want to buy, all right? So you wait for a change of character to indicate your reversal, or that's very essential. Change your character to indicate your reversal. For now, those are what you need. Then you use your final confirmation on lower time frame. Okay, on lower time frame using your either your swing low engulfing candle, any of the candlestick patterns. Okay, and then wait for price to come into there, and you move and move like that. Alright, so don't make the mistake whereby you are buying in premium because the market looks strong, right? The price is going up and you feel like the price will keep going up and now drop and enter the market. Don't make that mistake. You'll be losing your money. And don't sell in discount because the price is dropping. Oh, market is selling now. Then you want to join to sell. You will end up losing your funds. All right. So you want to trade smart. You want to secure your money. You want to secure your equity. All right. So smart trader sees the wait, and the wait. So that patience is actually the key thing every trader needs. All right, you can master the chart, master theory. If you have not mastered patience, you are not yet a trader. You have not mastered patience, you are not yet a trader. All right. So now let me give you certain pro tips for many people have been trading before now. This will just be a tip for you. When you see markets in premium and discount, okay, every time premium and discount, right? The thing is that premium and discount work on every time frame, whether higher time frame, 1 minute time frame, 5 time, premium and discount work on every time frame, okay? But you always use your higher time frame for your buyers and lower time frame for your entry, okay? Then if you combine your PDRAs, the PDRAs we've talked about, yeah, that's your fair value gap, liquidity, other blocks and the like, right? If you combine them with New York Open and premium zones plus liquidity, you will be having high probability reversals. Okay. Then entering are always best when you have change your character. Okay, within your PD zones. Entering are always best when you have change your character. So you wait for change your character and then you retest of reference points and you pick your entry. So you have it. You have it. You have it. Premium discount is not just Fibonacci. Take note, it's not just Fibonacci. Don't just mark Fibonacci and feel like, oh, it's discount then I buy. No, it's actually price model delivery used by institutions whereby when they combine it with the concept of those liquidity, fair value gap, and other block, it becomes a deadly weapon for sniper entries. So if you found this deep dive valuable, don't forget to like, subscribe, and comment what you want us to teach next. Or make sure you have any topics you are struggling with in the forex market and you feel like I should explain, then you can drop it in the comment section. I will look into it and I'll get back to you in real time. All right. So see you when I see you again. Thank you and you have a great day.